The majority of retail traders share one catastrophic flaw. Their stop-loss order is merely a fuse. It is a predictable line drawn on a chart, a mechanical surrender waiting for the executioner. They believe they are managing risk. In reality, they are providing fuel for the very fire that consumes their capital. A flash crash is not an accident of the market. It is a surgical liquidity event, a calculated test of weak hands. It is an engineered price shock designed to harvest those clustered mechanical stops. The moment the market smells panic, the professional algorithms descend like vultures, using the volume spike not as a warning but as a mechanism to invalidate your conventional risk management parameters. You draw a line. They know where that line is. They know where everyone has drawn that line. When price approaches, the volume explodes, the spread widens, and your stop is hit. Not because the market structure broke, but because your stop was precisely where the herd placed their surrender. The core theme of this discussion is survival. We are talking about the only stop-loss strategy that guarantees portfolio survivability through these engineered shakeouts. The fundamental truth is this: a stop-loss is not a technical calculation. It is a psychological barrier. When the pressure mounts, the noise becomes deafening, and the market asks one question: do you trust the line you drew, or do you trust your trembling hand? The market does not care about your hope. It cares only about your capital. If you rely on transient price action to define your exit, you will always be a victim of the flash crash. You must stop managing price. You must start managing structure. This is the difference between a student of the market and a professional speculator. The entire game hinges on this distinction. The crowd looks at the last print. The professional looks at the last accumulation base. The high-volume low generated during a flash crash is a piece of misleading data. It is an emotional signature, not a structural verdict. The volume surge that accompanies the sudden price decay is not the signal of a genuine structural breakdown. It is the signature of capitulation, a massive transfer of shares from weak, panicking retail hands to strong, patient, professional hands. Your conventional risk management parameters are based on the assumption of a rational market. That assumption is a luxury you cannot afford. When a flash crash hits, rationality vanishes. Only momentum and fear remain. The market is not rational, it is objective. It simply seeks the path of least resistance, and that path is always paved with clustered stop-loss orders. The structural stop is not a static price. It is a dynamic floor defined by the capital commitment of the largest participants. It is the level below which the entire established trend structure becomes fundamentally compromised, not momentarily challenged. It is the zone where a genuine supply imbalance overrides the previous demand dominance, not the price point where retail anxiety peaks. The stop-loss must be placed beyond the expected range of manufactured volatility. This expectation is not guesswork. It is a calculation based on the historical volume profile of the asset. You must determine the cost of a full psychological washout, the maximum allowable decay before the trend is truly invalidated. Anything less is merely speculation on the volatility, which is a fool's game. The mechanical approach to risk management, the percentage-based stop, or the arbitrary ATR multiple, these are all doomed to failure. They are based on symmetrical assumptions in an asymmetrical market. The market will always grant the professional more room than the amateur allows himself. Your protection must be rooted in the market's own architecture. The core rule is, the only valid stop-loss is placed at a point that invalidates the logic of the original entry. It is a structural verdict, not a price surrender. If the primary accumulation zone holds, the trend remains intact, regardless of how terrifying the momentary drop may be. If that zone breaks, the entire premise is false, and exit is immediate, regardless of current emotions. To survive, you must filter out the transient, high-volume noise. A flash crash is noise. It is a chaotic event superimposed on an established order. The challenge is separating the signal of genuine liquidation from the noise of retail panic. The professional strategy does this by calculating the true liquidity profile rather than reacting to instantaneous order book imbalance. The structural integrity of a move is confirmed by the sustained volume that preceded the flash crash. The stop must sit below the price level where the largest volume of institutional demand was absorbed, defining the core support base. This is the line you defend, not the minor reaction points where retail money enters and exits. The essence of the strategy is this. Your stop loss is placed where the structure of the demand fails, not where the supply momentarily panics. The flash crash generates a false supply surge. It momentarily overwhelms the demand, but it does not necessarily destroy the core demand base. You must allow the price to descend to that base and observe its behavior. This is a dynamic structural stop. It moves only when the accumulation base itself moves. It widens and tightens based on the velocity of the trend, the quality of the volume, and the depth of the last consolidation. It is a living parameter, not a deadline. It forces you to think in terms of market architecture, not isolated price points. You must study the volume profile. The largest volume node in the last major consolidation defines the core support. Your stop must sit unambiguously below this node. When the flash crash hits, the price will attempt to penetrate this volume cluster. If it fails to close below it, the penetration was a false break, a shakeout. Your capital remains invested. This is the psychological edge, the willingness to endure the deepest point of panic, knowing that your capital is protected by a structural line that the smart money is simultaneously defending. You are aligning your risk management with the institutional forces, not against them. The mechanical stop aligns you with the crowd, and the crowd always loses. I remember a time years ago when the market was gripped by a sudden, inexplicable liquidity drain. I was long in a fundamentally sound position, sitting on months of disciplined accumulation. The price action was steady, classic expansion. Then, in less than an hour, the price plunged, wiping out a month's gain. The speed was terrifying. The conventional stop on my sheet, the one I had marked based on a simple percentage decay, was hit within the first 30 minutes. I watched the screen. I saw the massive red candle print, the wick extending far below what any textbook would call support. The fear was paralyzing. Every instinct screamed, "Exit! Preserve the remainder!" But I had calculated my structural stop. That true defended line sat 5 points lower, at the absolute base of the last major accumulation period. It was a line that represented the commitment of significant capital, the price where the massive professional buying had taken place months prior. To break it meant the trend was truly over. My initial mechanical stop was already gone. I was staring at a paper loss far greater than I was comfortable with. But the price had pierced the high-volume cluster and was already trying to recover. It did not close below the structural line. It tagged it, hesitated, and began to claw its way back. The volume on the reversal candle was enormous, signaling the smart money was now aggressively buying the panic. I did not sell. I did not move. I held the line, not because I was stubborn, but because the market had not invalidated the structural premise of my trade. The system was intact. The core demand was still there. The price had only performed a wide-ranging sweep to harvest the weak hands. A perfect, textbook shakeout. The conviction required to hold that position in the face of maximum fear is the price of admission to this game. The next day, the price recovered half the loss. Within a week, it was trading at new highs. If I had followed the mechanical stop, I would have been out, having locked in a crippling loss, only to watch the market confirm my original thesis without me. The lesson is unambiguous. Your stop loss must be calculated to withstand the intended violence of the market. It must be placed at a depth that only a genuine structural change, not a temporary psychological aberration, can trigger. Anything else is placing a bid for the smart money to take your shares at a discount. You must override the psychological urge to panic. Panic is the market's greatest tool against you. The flash crash is designed to generate maximum psychological discomfort. Your mind screams for safety, and safety in that moment means liquidating the position. But the moment of maximum panic is often the precise low of the move. The successful implementation of this structural stop requires confirming that the calculated risk exposure aligns structurally with the long-term volume-weighted average position. The average cost base of the institutional players is your true floor. Your stop should be positioned just outside their calculated tolerance for a temporary dip. This deep alignment ensures portfolio survivability. You are not protecting your capital from a drop. You are protecting your capital from your own fear. The capital is the ammunition. Discipline is the weapon. If you waste your ammunition reacting to shadows, you will have nothing left for the actual battle. The flash crash is the market's way of washing out the sentiment. It cleanses the market of excess retail hope and weak positioning. It creates a vacuum that is then instantly filled by patient capital. The structural stop allows you to sit through this cleansing fire. It gives you the intellectual permission to withstand the financial heat. You must understand the psychology of the market makers. They do not look at your P&L. They look at the clusters of orders on their books. They know that a move below a recognized round number support will trigger a chain reaction of mechanical stops. The flash crash is simply the execution of a pre-planned order to trigger that cascade. Your structural stop denies them the cheap execution. It forces the price, if it is to genuinely liquidate your position, to move past a point of non-return for the larger players as well. This is the difference between being exploited and being a competitor. You must be positioned where their risk starts, not where yours ends. This requires a monumental shift in perspective. You must stop seeing the stop loss as a barrier to limit loss. You must start seeing it as a defining boundary of market structure. It is the line that separates a valid trend from a failed speculation. It is the demarcation point between profit potential and structural collapse. The price decay during a crash is often an overreaction. An extreme move on massive volume that does not close below the high volume base is inherently a rejection. It is the market spitting out the weak paper. Your stop must be placed at a level that anticipates and accepts this rejection, rather than being triggered by the initial price spike. This strategy demands patience and an acceptance of volatility. If you cannot psychologically endure a wider stop, then your position size is too large. The volatility of the stop must be inversely proportional to the size of the bet. The structural stop is wider, but its probability of being prematurely triggered is near zero. The mechanical stop is tighter, but its certainty of being hit in a high-volume event approaches 100%. You must choose your poison. Do you prefer a higher probability of a small, repetitive loss, or a low probability of a definitive structural loss? The professional chooses the latter. He knows that small, repetitive losses drain the account, but a single, premature liquidation during a shakeout prevents participation in the subsequent massive move. The structural stop is the only line that protects the integrity of the capital and the integrity of the trading plan. When the mechanical stop is hit, the plan is compromised, and the trader is often left confused, only to re-enter at a higher price or worse on the wrong side of the market. The structural stop ensures that an exit, when it occurs, is a logical, verifiable conclusion of the market's action, not a fear-based reaction. Your focus must be on the price closing, below the structural level, not merely touching it. The wick of a candle is the temporary frenzy. The body of the candle represents the capital commitment. A genuine breakdown requires a close below the foundational demand base, indicating that the supply has conclusively overwhelmed the institutional buyers. If you are stopped out, it must be because the market is telling you without a doubt that your original assessment of the trend was wrong. It should never be because an algorithm managed to trigger your predictable fuse. This strategy removes the element of exploitation from your risk management. The market's job is to extract capital from the impatient. Your job is to preserve capital through the periods of maximum duress. The flash crash is that duress. It is a psychological weapon aimed directly at your stop-loss. Your defense must be impregnable. It must be calculated with cold, hard analysis of volume and structure. The market will always test your conviction. Every shakeout, every sudden price plunge is a stress test. The amateur fails the test. He sells at the bottom, just before the recovery. The professional understands that the test is designed to transfer wealth, and he refuses to participate in the transfer. The successful implementation of the structural stop requires deep market knowledge, not just chart reading. It requires understanding where the market's true support lies, the price where accumulation turned into expansion. It requires the discipline to stand firm when the price action is screaming that you are wrong. This is the hard truth. Your profits are made in the waiting, not the buying. And the waiting requires an unbreakable defense. That defense is the structural stop. It protects your position from the noise, the fear, and the designed price decay of the flash crash. It is the ultimate line of defense for the disciplined speculator. You must calculate your maximum allowable decay based on structural integrity, not arbitrary risk tolerance. If the structural integrity of the trend demands a 15% stop, and you can only tolerate 8%, your position size must be reduced until the 15% risk aligns with your capital limits. You cannot compromise the structural reality of the market to satisfy your personal fear. This is the only way to play the game on the professional level. You must anticipate the market's attempt to shake you out and position your defense outside of that anticipated attack zone. This is proactive risk management, not reactive. The mechanical stop is reactive. The structural stop is anticipatory. The structural stop also filters out false re-entries. If you are stopped out mechanically, you are left confused, often re-entering too early, only to be stopped out again. If you are stopped out structurally, the message is clear. The premise is invalid, and you wait patiently for a new, clear structural setup. It breeds clarity and patience. The market respects only strength. Your strength is your discipline. Your stop-loss is the physical manifestation of that discipline. It defines the exact price where you admit the market structure has broken, and not a moment sooner. You must be uncompromising in this. The market certainly is. The single most important factor in long-term survivability is the ability to withstand these psychological assaults. They will always happen. The flash crash is an endemic feature of a leveraged algorithmic market. It is not an anomaly. It is a mechanism. Your stop must be engineered to defeat that mechanism. You must train your eye to see beyond the candle's color and the momentary high-volume panic. You must see the underlying structure of demand and supply. The professional's stop-loss is the base of the mountain, not a point on the slope. It is the foundation that holds the entire structure up. The market structure provides all the necessary information. It tells you where the big money is committed. It tells you how deep the correction must go before the trend is fundamentally broken. Listen to the structure, not the news. Listen to the volume, not the fear. You cannot afford to be sentimental about your capital, but you must be rigorous about your structural analysis. The price will go wherever it must go to find liquidity and trigger stops. It is the liquidity zones that define the flash crash's limits, and your stop must be outside those limits. This structural approach reduces the entire chaotic complexity of the market into one fundamental truth. The price you pay for speculation is the psychological burden of holding a position through engineered panic. The stop loss is merely the price of your exit if the foundational premise of the speculation is proven false. The successful trade is the one that survives its own correction. The successful trader is the one who survives the flash crash, not because he was lucky, but because his stop loss was calculated with a deep understanding of market architecture and psychological manipulation. The market has only one objective: to separate the unprepared from their capital. Your stop loss is your primary defense against this objective. If it is flimsy, you are exposed. If it is structurally sound, you are invulnerable to the noise. The final verdict is simple. There is no mechanical shortcut for a structural analysis. Your stop loss is either based on the architecture of the market, or it is a gift to the professionals. Choose wisely. Your survival depends on it. If these words hit you, it means you're not here by accident. Subscribe now, like this video, and leave a comment. That simple action helps more people find this content, and it tells me that my work still matters. But the battlefield of the market is the mind, not the chart. If you want to understand the true psychology of speculation, you must read the one book that defines the game. I am talking about Reminiscences of a Stock Operator. It is not historical. It is a permanent education in human nature and market cycles. The book is pure truth. Get your copy today. The link is in the description below.